All right. Do you guys want me to go through the discussion questions?
Sure.
You want me to kind of facilitate?
I can read number 3 if you want, because we're just supposed to read it out loud. It's not questions on number 3.
Oh, okay. And
So,
Hi, guys.
okay, does anyone have a spiritual thought or scripture or anything that you want to share? Hey, did we lose Samuel? Oh, bummer, man.
we'll hop back on soon.
So what were you saying? You were gonna read which one?
The one that says number 3.
Oh, number
Number
3.
2 is the spiritual thought, and then number 3 says, choose a student to read the following aloud as the group follows along.
Okay. Or maybe we should wait for
Samuel to jump back on.
Okay, I've got a spiritual thought. Hold on.
¿Cómo ha estado su semana, Miguel?
Oh,
All right, sorry
pesado.
about that. So, Orson F. Whitney, he said, "Spirit of the gospel is optimistic. It trusts in God and looks on the bright side of things. The opposite or pessimistic spirit drags men down and away from God, looks on the dark side, murmurs, complains, and is slow to yield obedience." I heard this quote a couple years ago, and I love it, and I cut it out and put it on my bathroom mirror. I like how the gospel is a positive thing. Man, if you watch the news or, we live in the world and it's just becoming negative and pessimistic about so many things. But I love how the gospel, like we're supposed to take an optimistic view. Favorite quotes.
Right, thanks.
All right, looks like Samuel, you're back with us. All right, are we ready to proceed?
I think so.
Yeah.
All right.
Oh, come on.
Hey, Cameron, you want to read it?
I'm going to go ahead and read it. Sam's saying his internet keeps dropping the call.
Oh, okay.
So it says, so far in this course, we have seen a few common threads and takeaways. Founders matter. Experience, passion, and vision shape the business and can make the difference between success and failure. Business plan at the founding stage of the company is a collection of hypotheses. In other words, guesses. Startups create value by systematically testing hypotheses and making changes to the plan when the test results indicate a need to change. Early tests tell us a lot about the viability of a business and where more information is needed. Previous cases analyzed business models the founders had already chosen. Now we get to see a company at the moment of a choice. Now
Okay.
it's number 4.
All right. So now we're doing a vote right now, then, right?
Yep.
So I'm gonna keep a tally. Okay, so which business model option do you favor? Who favors the traditional strategy?
Me.
Either you guys? You do?
Yeah.
Okay. Traditional. Yeah. Okay, razor and blades strategy for data analytics. Cameron, your data analytics?
Yep.
Analytics. Okay. So when Samuel jumps back on, we'll ask him. Okay, so let's go around and we'll give each person a chance to share why they voted the way they did. Who wants to go first? And then if he jumps back on, we'll just wherever we are in the discussion, let's just kind of stop and ask him what his vote is.
Okay.
So let's just kind of keep an eye on that. But who wants to go first?
I can go first.
Okay.
The reason I chose data analytics is it's got a really good promise for itself. They pretty much would share or sell the work of other people, kind of a thing. They could get a lot of sales rapidly because it'd basically be almost at cost what they'd be selling it for. The downside would be that they would have to have a higher capital up front, but the return over 6 years would be a lot higher than any of the other plans. And it would be a continual growth as well because they'd be continually growing it. So it would be beneficial because schools, if they wanted to, they could buy it. Researchers could buy it since it'd be so inexpensive. And with the competition that's going to be coming out sooner or later, like the neoprene or whatever it was that was the competition that was going to be $900, they pretty much would be in that same price range and be able to gain market share or maintain market share while those companies were coming out.
Okay. Good. Hey Samuel, can you hear me?
Yeah, I'm here. It keeps dropping. For some reason, my internet's kind of bad. Sorry.
Okay. Hey, so we just voted on which business model we favored. So what's your vote? Do you vote the traditional strategy, the razor blade type strategy, or the data analytics strategy?
I'm going for data analytics.
Okay.
What did you guys vote?
So Miguel is traditional, and then me and Cameron are also data analytics too.
Okay.
So now we're going around discussing why it is that why we voted the way we did. So are you done, Cameron?
Yeah.
Okay. Miguel, do you want to go or you want me to go?
Yeah, I can go.
Okay.
Well, I choose the traditional because I thought that when with the Genius low cost approach, they will target different entities from different sizes as the research institution, pharmaceutical firms, laboratories, and diagnostic tests, which could be the major customers. They will be the customer will be expected to pay a reasonable price, which will increase the demand. And also because the competitors could not compete because their prices are up to more than the double of the price. The founder's goal, we read that he wanted to offer or give something back to the humanity or something like that. So I think that these entrepreneurs just want to serve or to contribute with this device. And this traditional model for me represent this because he will not maybe uh, getting or generating all the revenues that he could, but he's also like giving back this something to the people. And lastly, because the investor goals in the analysis that I made, I came up that the traditional strategy could recover the initial investment in less time. So I think that for the investor, that will be the most important, in how much time they could recover their money. So that was the reason. Well, those are the reasons that I choose the traditional strategy.
Okay. So I chose data analytics, and my feeling with that is the founder, like Miguel mentioned, one of his guiding principles in his life was that he wanted to do something that contributed to help people. And I feel like the data analytics, it helps accomplish that because it's low price. It's getting it out in the marketplace. It's going to maximize like their penetration into the market. And then, you know, we're in an age where information is more powerful and more valuable than hardware. And I think that that will continue to be the case. And if they can build a database of all these tests, that will be far more valuable than their products in the long run. So over the long haul, it'll be much more profitable. But that's my feelings.
Okay, so
Samuel?
I went with data analytics. Similar choice for the same reasons, pretty much. The first one, most important for me, is that one. That that was his belief, that was his intention since he was growing up. So I would stick to that. He's not going to have another. It will be hard for him to have another opportunity in his life to where he can impact the world or whatever he wants to impact his community or his country the way that he could with this sequencer machine or whatever technology he's created. So that's the main reason I would go with that. The second is because, yes, it's the one that would, I think, cause a greater impact on the long run. It might take more money. It might take more time. But at the end, I mean, it mentioned there that they could become like the Google of their industry, right?
Yeah.
So not many companies get to that point, right? So there's a potential there to become something far greater than just a company that sells technology to be able to run DNA tests, right?
Yeah.
So if they make the right moves, if they get the right partner, perhaps Google, Amazon, to be able to host all that data, then I think they could do something a lot bigger. And yeah, maybe not make that much money at the beginning, but like you mentioned as well, like the market is going towards that, right? Whoever hosts more information, whoever has all the data has the power.
Yeah.
And so I think if they get to that point, even if it takes a little longer to get there, it would be the right choice at the long run. It would just be a matter of, I guess, finding out what the investors really want or what they expect, or getting new investors or getting some sort of partners that, back him up with that. But I think that would be the best option.
Okay. All right, good. So the case study, the thing says using a polling tool that allows students to vote and see the overall results. Go through the following questions. We don't have a tool. Does anyone have any ideas about this? Using the Excel model you created, answer the following questions individually and then compare the answers as a group. So did you guys go through the Excel spreadsheet and go through changing like those percentages?
Yeah.
I did.
I didn't.
So
The question is, what are we holding equal? Like, because are we going off of the data that was there before?
the question is if we increase sales but hold everything else equal, the time to pay back Earnings before interest and taxes. Oh, after taxes divided by sales. So is that that's our margin?
EBIAT is the earnings before interest after tax.
So if we have like $1 million in sales, and EBIT is a 20%, that means that we made 200,000.
Yeah.
So you want to increase that number, right?
Right.
The payback refers to just start earning some revenues or passing the 0 point, or just start not investing or losing more money.
The payback point is where, like, it shows the timeline, the cash value and the timeline. It's where those two meet after you do the burn rate cash flow below. So as you're coming up, once that meets again, that's your payback, because that's when you pay the investors back what they put into the business.
Okay, so when I return to 0, right?
Right.
Yeah.
Okay.
So if we increase sales and hold everything else equal, time to pay back decreases. Agreed?
Well, it depends on what sales. So it's
If
if NOA sales increases, cash flow, is that the one you're on?
yeah, number one.
Are you on the EBIAT or the NOA?
Yeah, the EBIN.
So if we increase the EBIAT sales and
Yeah.
everything else equal, time to pay back increases.
Oh, time to pay back, it like goes out longer, so you make less money if that.
Oh, is that what it's saying, or is it saying like you get paid back faster?
Well, I'm saying, well, it says if we increase
So
EBIAT sales and hold everything else equal, time to pay back, I would think decreases if you're making more money, but.
right. No, yeah, you're right. It's decreased. I was thinking my head somewhere else on something else. So I can even show it here for Sam so that way he can see it. So this is what we're talking about, Sam. Is this information over here? Pretty much where this hits 0, that's the kind of like the payback point.
Are you sharing your screen? Because I can't.
Yeah. Can you see anything or no?
I can see you. I can't see your screen yet.
Yeah.
Weird.
I don't know. It might be my internet.
This way.
Let me see if I can see it on the computer.
Okay, I'm sharing it now. Can you see it? Can anyone see it?
Yeah, I can see it.
Okay.
So you can change that number, right? And we can see it
Right.
going. Yeah.
So change this to a lower amount. It takes longer for payback, in fact.
Yeah.
Payback. But yeah, as you said, as this increases, the time to pay back decreases drastically.
Okay. All right, cool. We move on.
Sure.
Okay. All right. So compare. So we went through that. So if NOA/sales increases, cash flow decreases or increases, decreases, or remains the same. So NOA stands for net operating what?
Assets.
Assets divided by sales. So that's like our costs, right?
Right. Yeah, as that number goes up, our cash flow decreases.
Okay. So it decreases. Okay, that makes sense.
Yeah.
All right. Any more discussion on that? Okay, for the next one, so in the case online, the picture's broken, so we can't see. Can anyone see that curve that's pictured?
I can.
No.
If you're, who can? It's broken for everyone, right?
Yeah.
Okay. So, all right. So we can't see that to know to have a discussion about that. But it says once everyone has responded to the question without help from anyone else, compare answers, discuss until the group settles on a single response. So, what strategies have we seen that flatten or lengthen the cash flow curve? Specifically, try to draw the cash flow curves for St. John's products, Rent the Runway, and Dropbox as they were described in the cases. Just make a rough guess as to the shapes of each of these cash flow curves. So, well, this is kind of hard without. Does anyone have any thoughts?
I guess it would just go off of like what their overall business plan was to get revenue and what their cost was and how they were going to implement it to make sales. Because pretty much all we got to know is the sales, the cost, and
Yeah.
what it was that cost them to start up, I guess.
Okay. Yes, I guess I can see this. It's an interesting way. I haven't really done the cash flow, the free cash flow analysis before, and now thinking about like Rent the Runway, for them to accelerate their growth and for them to bring on more investors, like that's costly, right? I can see how that can affect the bottom line, and it can affect their break-even point and those things. I went through the Excel spreadsheet quickly, and I haven't had a time to really get in and play with some of those numbers.
Yeah, me either. I think like looking at Dr. John's with the spin brush and everything, he sold them with a pretty good marginal profit, even though they were cheaper than the competition. It was growing really quick. So I guess if we were to take that and put it into the whole, when we have the Excel spreadsheet, we knew that the NOA, or the net operating assets, were low.
Mm-hmm.
And we know that if those are low, then obviously cash flow is faster and higher. And we knew that they were bringing on a lot of customers, so their sales growth was going, and the EBIAT was going as well. And they had a pretty consistent sales growth, so I would say that their free cash flow curve was, I think it dipped a little bit for maybe R&D or getting things set up, because they said they took like 3 years or something, long case ago. But I think after that it started climbing really quick because their NOA was low, their sales growth was pretty much the same, and their EBIAT, or their sales, was growing quickly as well.
Mm-hmm. Yeah, that's a good point. That Dr. John's, that product is unique in that it's so cheap and it has such a high volume. I could see how trying to accelerate that would be good. Okay, any comments about, it says Rent the Runway. The founders of Rent the Runway had been, if they had been able to convince the dress designers to retain ownership of the dresses, what impact would that have on Rent the Runway's cash flow curve? Would it flatten, steepen, shallow, or deepen, increase or decrease the time to pay back? So if they could convince the dress designers to retain ownership, how would it impact?
It would have decreased the time for them to pay back. I mean, their costs would have gone down a lot. That was pretty much their only cost. That and I guess the website, just the logistics of the whole thing. But they had to buy the dresses. Like if their first idea would have worked and the way that they convinced them to kind of, in a way, kind of partner with them so they could use their dresses, then they would be using their money pretty much to fund their business, right?
Yeah.
So it didn't work out like that, but that would have been a really good model, I think. Investment would have been a lot lower, so they would have been able to pay it faster, and their revenue would have been higher as well,
Yeah.
I think.
Okay, good comments. Any other comments? Okay, so for the next one, what decisions did Drew Houston make in Dropbox that favorably impacted the cash flow curve? So that was the freemium model, right? So
Oh, yeah, that's true.
what decisions did he make?
What decision did he make for what?
For Dropbox. So I'm trying to remember that case. Like it was about a freemium model and then a paid model. Was his decision on to kind of fragment the product and have different levels of costs for the different product, or did he try to keep it pretty much uniform?
Yeah, his whole decision was, if I can remember right, whether to make it specific for like business and consumers or to pretty much just leave it as it is and continue driving it that way, keeping it simple. And I guess to answer what decision did Drew Houston make in dropbacks that favorably impacted the cash flow curve, meaning it increased it. Um, Favorably impacted.
I guess you could say. I guess maybe you could say that like he used the Amazon S3. That's pretty cheap service. Like that was keeping his costs low rather than build out his own data center.
Right.
Well, he also switched from actually, you could say, active marketing to more of a organic approach, and where his freemium business kind of pretty much brought him thousands and thousands of people into registering for a free account, and then he would have closed a certain percent of those into people that would actually become paying customers. So instead of paying for advertising or paying for people to come to him, he figured out a way in which the same people that would already be there would be referring a lot more people to bring them in, and then he would just convert that amount. So his costs were a lot lower. He wasn't spending that and still making, I guess, a good amount of money.
All right, that's a good point. Okay.
But he was losing currently money, right? With the freemium model. I can't find the analysis, but I think that he was losing, I don't remember if like 2,000 or something like that.
When we did the analysis, we actually based it on a year, but he had only been going for 6 months. And when we changed it back to 6 months, he was actually profitable.
Yeah, I
Had he
remember.
continued in that same trend, and in fact, he would have increased more because he was increasing by a lot. He would have been very profitable in a year's time, even with the freemium. Yeah, the freemium did cost him, but when we did the analysis, it was because we assumed a year, and it threw our numbers basically saying if this is all he got for a year, yeah, he'd be negative. But at the 6-month mark, he was positive.
Yeah, I remember. Thanks.
Okay, those are good comments. All right, so now let's look at the choices GenapSys has from a cash flow standpoint. For each business model under consideration, compare the following. The net present value. Some of the opinions have similar options have similar net present values. Which is riskier? Is it advisable to take additional risk for a similar NPV? So do we attack these individually or all together? So,
I think altogether.
okay, so that's net present value, and then we also want to compare how GenapSys raise funds to support each option. Is any option clearly more attractive to investors? Support your answers in your discussion. And then number 3, for each option, how much of a company will the founders have to give up to reach the goal? Okay. So there's 3 different options, right? So let's just take one and kind of go through these 3 things with each one.
Okay, so the first one is the traditional.
Mm-hmm.
So the net present value of that, I'm not even sure.
So I guess net present value with the traditional model, they have a device, right? It has intellectual property in it. They're ready to go to market. That's worth something. So their company's valuable because they have their competitive advantage is that it's accurate, that it's fast, and it's cheap. So I would say that first option, the net present value on that one's pretty high.
Well, couldn't all the net present values then be the same? Because they're right now deciding which area to go or which path to go. And those are kind of the same facts they have along all 3 of them.
Yeah, I guess, but if you think about the last one, the data analytics one, most of the value that database you're gonna have to discount the value of that because that won't be realized for like 5 or 6 years. So I don't know. I think that's going to be that company is more valuable if that's what their plan is because they're going to build a database.
And
that's not even part of the business plan of the first traditional model.
Right. And I think with the traditional model, like how they're going to sell it at a higher cost than they would the other 2 models, gives it a first initial present value of higher amount because they're going to be selling it at higher amounts.
Yeah.
The second and third one, the prices get lower and lower, showing that kind of what you said. They have a lower net present value because the prices of it would be lower. What they're planning on doing would be lower, but the overall end might be higher. But as net present value, yeah, traditional would have the highest net present value.
I agree.
I think the second and third option, the razor and razor blades, and then the data analysis, have pretty similar net present values because they're both discounting the price of the system to a fairly low amount, and one's more selling the data, and one's selling the cartridges as kind of its mainstream.
Yeah.
Sure.
I mean, they have a bit of a difference because the razor and razor blade, they were going to sell them for they will send the machine between $5,000 and $7,000, and then charge $200 for the test cartridges. And then on the last one of the analytics, they were going to give it for $100, like actually $3,000.
system, yeah.
3,000 or lease it for 2,000 per year.
Right.
And then the cartridges were going to be $50 or $100. So they would sometimes even be losing, because I think it cost them about $100 to run one test. So they were going to give it at price or even lose a little bit of money, just to the idea to be able to increase the research, to increase the people coming at them so they can gather more data. Then the data is the one that would actually be worth something after that. So it would be more of an initial investment.
Yeah, that's true.
Okay, so all right. So what about raising funds? So that we're talking about present value. So there's some differences there. What about how GenapSys has to raise funds to support each option? I guess when I think of that, do they even need to raise any more? If they go with the first model, they're going to keep their margins high, and they're not going to sell like, they'll probably keep up with demand a lot easier, right? So do they even need to raise more funds, I wonder? I don't know.
They might have to. It mentioned there that they were spending about 700,000 a month.
That's true. Yeah.
Was it a month?
Yeah.
And that's without any production, I think. So numbers specifically, I wouldn't be able to know, but I mean there must be some cost involved in producing those little machines. But yeah, the volume would perhaps be lower because the prices are higher, and they would be generating more money because of that as well. But it would balance out a little more.
So I would probably think that they would have an easier time raising funds as well. It's probably less risky, right? Because their business model would support, the revenue would be there, someone investing would get paid back sooner.
Right.
What about the razor blade option?
I mean, they would still have to. I think they would still have to raise some more money. I actually like Razor Blade too. I was thinking more of going on a hybrid. They mentioned that. Just kind of like as a plan B, right? And they weren't planning on competing directly with the other companies that produced or had these services. So I mean, they could have gone that route to create some income, and then still be working at the generating the database and stuff like that. I thought maybe that would be a better alternative, but investment, I think they'll still need a lot of investment. I'm not sure how much though.
Right. And all three of them, they're going to need investors of some type, but the risk increases. Like the traditional one, pretty much it was really low risk because it was already proven pretty much this is already out there, this is the demand for it already. Pretty much the only thing we have to do is go against competitors and gain some of that demand in order to break even and make a profit. Whereas with the razor blade, there was more of a risk because they pretty much were discounting it, lowering their margins, hoping to get into more places and pretty much beat the competition in its own game. And then the third option was the highest risk because they pretty much were giving it, like Samuel said, at cost, not getting any revenue for a while. And basically then once they were able to get enough of a database to sell out that database, and that's where their money would come from. But it would take a long time for them to do that. I think they said something like 5 years or something, what they were expecting to get that kind of data and everything in order to sell it at the prices they wanted. So going to investors, I mean, it all depends on what type of investors they go to. Ones that can see the goal and be like, okay, I want this to pay out as high as possible, even if it takes longer, or one that just says, I want to put in the amount I want now and get it back quicker. It all depends on the investors, I guess, on which ones they go for.
Yeah. Okay, good point. Okay, what about For each option, how much of the company will the founders have to give up to reach the goal? Man, how do you quantify that?
Give up.
I mean, I guess the more other people need to invest or the more money you need, then the I guess the stock or company worth gets diluted more and more because of or the shares, right? So more people are putting in more money if it's valued at a certain amount, and then they kind of lose a bit of its power. I don't know if I'm explaining myself, but the more money that people are putting into the company, then the less decision making I guess they could have. So, I mean, option 3, I believe, is the one that's going to require more money because it's going to require more time and more investing. But calculating, I'm not sure.
But if option number one, if they're like a $40 million company, just for the sake of example, they could give up 10% of the company to get $4 million investment. But if they can sell the idea that being the Google of the Genome Project or whatever, if that makes them a $400 million company, then they can give up 10% to get $40 million invested, right? So like what you're saying, the key is how they evaluate the company.
Yeah, it'd be what they show that the company's worth once the idea gets going.
Yeah, I mean, but how? Yeah, it's just kind of selling an idea because they haven't sold anything.
Right.
And
Totally, yeah.
is how do you evaluate something like that?
Exactly.
I mean, I'm sure they have their ways of doing that and alpha potential and whatever, but they already had investors as well, so they would probably have to seek bigger investors, and you're already putting a lot more people into the plate.
Yeah, it might be problematic going that route.
Yeah, because you can always say that your company's worth so much, but if you don't have the data to back it up, they're like, I don't see it. So
Yeah.
maybe the valuation of the company right now isn't very high, so they have to give away more in order to get the amount that they would need to then make it a 400 million or even $4 billion company later on.
Yeah, either that or partner with someone like Google, Amazon that has a lot of money.
Right.
Have
And pretty
them,
much sell them again, give them a percentage.
yeah, have them carry that cost.
All right. So, so are we ready to? You guys want to? So this question is: put yourself in the shoes of Espandio, Poor, and Rastegar, and the investors. You must decide as a group which business model you will choose. Be ready to explain this choice in your post-discussion write-up. Okay, so we voted at the beginning. Now let's talk about it again. So, what do you think? What do you think they should do? Has anyone changed their mind?
I'm still going for number 3. I mean, they got so far already. Either that or a combination of like a hybrid. I'm not sure. To kind of
Yeah,
get the concept going.
I'm still sticking with number 3 because the payout return at the end is going to be a lot higher than either the traditional model, which would be low risk, but would bring in a quicker revenue. But higher risks have higher payouts. And really, if they do become the Google of like the genome sequencing, to where people can look up and be like, I need the genome sequencing for this, for such project that I'm working on, that right there is a business that they can sell that'll continually grow. Whereas if they go the first or second route, they're going to have to consistently do sales of the machine, sales of the slides, everything like that, which they'll have to do on the third one as well. But the main source of their revenue will be from the data that gets pulled in on the third choice.
I mean, I think the main thing here too is that they actually start, that they get the product out there Because if they wait, I mean, if they don't do anything with it, then someone else is going to come out with something similar, new technology. So I mean, it's just it's an advantage in itself. They're going to start gathering information, using their new technology. So I think it's a win either way. Even if they go with the data route, I mean, might not be making a lot of money, but who knows? There might even be companies interested in saying, "Hey, yeah, that's cool. You can do that, but can we buy some of your machines as well? Because we want to do our own thing." You don't know, right? Because they haven't even shown this technology to anyone. But once it's out there, they don't really know what could happen with it.
That's true.
Yeah, I'm still thinking that the data analytics, that option number 3 is the best model. I think it serves people the best, and the potential for the upside is huge. And the case talked a lot about how clinics and research facilities and hospitals, like there's something to be said for products that are kind of in their hands already, and so that the option number 3 gets it into the hands of the most people because it's affordable, and just that market share that they're going to gain, I think that's going to help them over the long term.
Mm-hmm. Actually, I also mentioned that most of the biggest use, I think it mentioned, was for research. So, I mean, I work in a company that actually is a technology for research, and a lot of people, sometimes it's just a lot easier for them to just have someone do it for them, like hire a third party. Just gonna, oh, you already have the data done, just send it over for me, and I'll just, run the test instead of having to gather all that information and I'll do the whole process. It's just a lot easier for people. So that's another advantage.
Yeah. So what do you think, Miguel?
I think that all of you, well, I think that we all agree that number 3 could be a good options. That I just will suggest that both entrepreneurs just have to cover themselves and just get enough funds, because we are talking of an industry that spends a lot of money in research, in different development programs, that I just scared to go for this option, because I think that it's too risky, because you don't know what will happen during all this time. But I agree that if they are able to cover themselves and get a good financial program, they will be able to price up a lot of money, and also get all these huge database that could help to those medical research companies to create or develop new medicines, new drugs that could help to all the people. So I think that is very ambitious, but also it's very rewarding in the future.
Okay. All right. Well, I think that wraps it up. Any final comments?
No, that's it. We only have one case study this week, right?
Yeah. So the other thing is just, it's not a group assignment, that part 2 of next week. I haven't even looked at it yet.
Cool. We'll get some break.
So yeah. All right. Well, I'll post this link to this in the little chat thing in just a few minutes.
Appreciate it. Thanks, guys.
Thanks a lot. Have a good week, guys.
You too.
Yeah.
I'll see you.
Have a good week.